Welcome to the Everything Financial Radio Show here on the Legacy Radio Network. I'm your host, Dennis Tubbergen, and we are here every week at this time. Or if you're a new listener, we're awful glad you're with us today. Mark your calendar, put an alarm in your iPhone or whatever it is that you carry around, and remind yourself to tune in again next week. Hey, we've got a great show lined up for you today. We're going to have Mr. Karl Denninger joining us. Karl's work can be read at market-ticker.org, and we're going to get Karl's take on what's going on in the economy. And in the interview with Karl, I'm going to get him to share some of the research he's done on medical spending in this economy. The medical spending in this economy has been increasing exponentially, and in Karl's view, that's one of the reasons that we're going to see the trend continue to reverse, and we're going to continue to see a sluggish economy, and we'll see the exponential increase in medical spending reverse as well. And he's done some very interesting research. I'm very glad to have him on the show today. Also, if you've not attended one of our discovery groups recently, you can go to personallegacyseminars.com. That is personallegacyseminars.com. And you can register for a couple this week or one next week. There's just a few seats left. On Tuesday, September 11, we'll be at Sunnybrook Country Club in Granville. On the 13th, we'll be at Watermark Country Club in Grand Rapids. And on the 18th, we'll be out in Boulder Creek, or at Boulder Creek in Belmont. PersonalLegacySeminars.com to get more information. We'll be very glad to take your reservation if you have not attended a discovery group in the last 3 months. Also, if you've not yet requested our guide, our 2012 guide, Surviving a Market Crash, you're very welcome to go to investingapproach.com. That is investingapproach.com. And just enter your name and address. Let us know where to mail it, and we'll be very glad to send it to you. That, again, is investingapproach.com. Also, we've interviewed a lot of terrific guests here on the Everything Financial Radio Show. Mr. Gary Schilling, Professor Lawrence Kotlikoff, Mr. Jim Rogers, Peter Schiff, Harry S. Dent. All those interviews are archived, and you can listen to those at everythingfinancialradio.com. That is everythingfinancialradio.com, and just click on the archive section, and we'll be very glad to have you visit there and listen to some of our archive shows. I am pleased to have joining me today on the Legacy Radio Network Mr. Karl Denninger. Karl is a prolific blogger and commentator on all things economic, political, and certainly would encourage you to check out his work. And Karl is a frequent guest here on the Everything Financial Radio Show. And Karl, thanks for joining us again today.
Oh, thank you for having me on.
Karl, let me start with what's going on in Europe. There was a New York Times article published yesterday that told the story of a senior executive for a multinational payroll processing company who lived in Barcelona, Spain, who left his company and moved his family to a village near Cambridge, England, where he's going to take the reins of a small software company. And he took all his money out of Spanish banks and moved them to British banks. He said of the situation in Spain, there's just too much risk. Spain's going to be next after Greece, and I just don't want to end up holding devalued assets. He said the situation in Spain is getting worse and worse, and there is no hope. What do you make of that story?
I think it's true. We've got the same problem on a global basis. This isn't just a Spanish issue. The question still arises, here in the United States. You look at what's going on here in the U.S., for example. We've been emitting about 11-12% of gross domestic product in new debt at the federal level to prop up the economy now for 4 years. And that's a direct devaluation of the currency. It's a direct devaluation of everyone's purchasing power. And so what happens is that although the stock market, of course, is not that far off of its all-time highs from 2007, if you look at it in terms of currency-adjusted value, it's doing terrible. Not to mention that just nominally, you're still down 15-20%. If he was holding anything that was linked to real estate, then he's got an even bigger problem, because you've got the same kind of situation over there in Spain as well as everywhere else in Europe that you have here, in that so-called alleged capital assets are outrageously overvalued, just as they are here in the United States. And as the wind comes out of that, you're going to see a contraction in those prices.
Karl, I noticed that as I was reading a CNBC article, Moody's just recently downgraded the Eurozone rating outlook to negative. Well, rating agencies are notoriously late to the dance. Moody's, I think, has an AAA rating on the EU. What do you make of that story? Are they just doing what they should have done a long time ago?
Well, they're not only late, they're several steps higher than they really ought to be. The problem with all of these systems, within the European governments, within our government, on a pretty much a global basis among the debtor nations, is that we have not yet been willing to have a conversation with our people, nor have they, about the services they want government to provide and how much taxes they are willing to pay in order to have that government. So, we constantly have this debate about Social Security, Medicare, Medicaid, things like this, food stamps and all the other entitlement programs. Over in Spain, you have the same basic problem. You have unemployment that is sky high. It's going higher. You have a huge social safety net, which has enormous cost. Nobody is willing to pay more taxes over there, and there's a certain point beyond which increasing tax rates just causes evasion to go up. You don't get any more money. And at the same time, nobody's also willing to say, we want to be more self-reliant. We want the government to provide less. And so you have this coffin corner kind of situation that comes in where the economy cannot advance because the amount of debt that the private sector can take on has been reached. There is no way to get out of this box other than to take those asset prices down and allow the people who have made these bad loans and bad investments to go bankrupt. That's the only way out of this. And yet nobody is having that conversation. And I don't think we're going to have it until it is forced upon us because it's just too painful and politicians are afraid of losing their jobs.
Karl, that kind of plays into what you wrote about on your blog recently. You actually posted it on my blog and obviously gave credit to you who developed this chart. The chart you put on the blog, to refresh your memory, was titled Debt in the United States 1980 to Present Cumulative. And on that chart, you graphed household debt, business debt, state and local government debt, and federal government debt. And it appeared that even though total debt levels had grown slightly since really the financial meltdown, the only way the total debt level had grown is that the federal government debt had grown exponentially, and all other areas of debt had declined. So what does that tell you about how long this can continue?
Well, it's actually a little more complicated than that. And here's the really nasty part of that chart, if you look at it very closely. And some of it's not immediately obvious from looking at that because a lot of those lines appear to be essentially straight. Okay, in other words, there's no expansion or contraction with very small changes. But in point of fact, household mortgage credit has contracted a relatively small amount, about 10% from the top. Okay, yet the price of houses has contracted by about a third. So what's actually happened here is the leverage in the housing sector has actually gone up rather than down. Okay, commercial and industrial loans have not contracted at all. In fact, they're at an all-time high as of right now. So there was never a contraction. There was never a shrinkage in leverage in the commercial and industrial sector. There was never a shrinkage of leverage in any of the other areas of borrowing except one, and that is financial credit. That is the margin credit, if you will, that is created and circulated between various financial institutions to back up their crazy speculation. That collapsed in the 2008 crash, and that is what all of this federal government debt that has been taken on since, $5 trillion, that's what has been replaced. So when people talk about the federal government's deficit spending, and Obama and the Republicans, remember, all spending bills must originate in the House. So without the Republicans completely on board with this, not $1 of this debt would have been created and spent into the economy. When you look at where that money has actually gone into the economy, what it has replaced, it has gone directly to the financial institutions in this nation. This is why there's been no net improvement in the economy in the United States over the last 4 years.
When you say all this, just for our listeners, Karl, in the couple of minutes we have left, when you say all this money has gone exclusively to financial institutions, can you expand on that? Exactly what did they do with the money?
Well, they filled the holes in their balance sheets that were created by all these losses. This is where, if you start reading some of these charts, all of this stuff becomes clear. And this is the discussion that nobody in the mainstream financial media wants to have because it leads to some very uncomfortable conclusions. But if you constantly hear about the decrease in leverage and how the economy is delevering and has been delevering, the Z1 credit numbers do not lie. There's been no delevering that has taken place anywhere except within these banks. That's the only place leverage has come out. Everywhere else it's expanded.
So, Karl, that means that we have, as A. Gary Schilling, who was a guest on the show a couple of weeks ago, said, we have a coming age of deflation and deleveraging, and in your view, that's going to get ugly. Can you describe for our listeners, we'll pick it up on the other side of the break in the next minute or so, some of the things that you expect to happen and maybe when?
Well, just as an opener, the amount of debt that is in the system now needs to be cut by 50% to be returned to sustainable levels. And we'll get into the details of that on the other side. It'll take a while.
All right. We will be back and return to our conversation with Mr. Karl Denninger here on the Legacy Radio Network and the Everything Financial Radio Show. When we return after these words, stay with us.